A frequently asked question that we get is this only for Singaporeans? The answer is there isn't a restriction on any nationality buying property in the UK. Relating to that then is, do we get lending in Singapore? Is it a Singapore bank? Is it a UK bank? Can we get lending or do we have to buy in cash? Well, Singapore banks or even the UK high street banks only lend to properties in London's Zone 1 and 2 or new builds in Manchester, which obviously we know by now don't give you very much yields or cash flow. But that said, there are opportunities for first-time buyers, regardless of age. That's another FAQ. If I'm in my 60s, can I get lending? If I'm a student, 18 years old, can I get lending? And the answer is yes, if you know the right people. The key distinction here is how the UK and Singapore lenders operate. Because in Singapore, with cooling measures such as your total debt servicing ratio, there is a cap on how much loans you can borrow as a percentage of the income you're getting. And hence, obviously, people feel like their hands are tied. Unless I earn a lot more income, how am I going to get more lending to buy more investment properties? That's a bit of a stuck in a rut situation. Also, because in Singapore and Malaysia, a lot of the properties are alligator properties, where if you take a loan, the rent can't even cover the loan. And the lenders know that, right? Because they know how much the property is going to rent out for. Let's say it's you're going to get 4,000 or even 5,000 in rent. The mortgage on a 1.4 million property will be easily $8,000 or more. So they know that the difference of 3,000 to 4,000 has to come up from somewhere, either from your savings or from your earnings. And that's why the age of the borrower becomes very important in Singapore. So if somebody is in their 60s, for example, the lenders are assessing the risk. Firstly, they know that the person's not going to work for another 20 years, right? They're going to retire in 5 to 10 years. And then what happens to their loan? If they give you a 20-year loan, you're not going to be able to make up the shortfall in difference after you retire, for example. And hence, the borrower is then deemed as higher risk to the lender, which is why they then restrict the number of years on the loan to say 10 years or 5 years, which obviously if you're borrowing more than $1 million and having to pay up in 5 or 10 years, your monthly repayments every month are going to be exorbitant. And it just doesn't work for cash flow anymore. All the more it doesn't work for cash flow. In the UK, it's different because you get access to interest-only lending. If you borrow at, say, 6% per annum on a 100K loan, you simply pay only the interest every year. If you're taking an interest-only loan at 6% on a 100K loan, that's 6,000 a year, which I think is 500 a month of mortgage expense. And it doesn't matter if you're on a 2-year loan, a 5-year loan, a 10 or 20-year loan, the monthly mortgage payments going out is the same, that same 500 a month. Doesn't matter if you're in your 30s, 40s, 50s, 60s, or even your 70s. Our oldest student is 76 years old, and he too can get lending. And even if you have a 2-year loan, you don't have to pay the full capital upfront at the end of the 2 years. By then, you have built your credit stripe, you have proven yourself with more landlord experience, and the lenders in the UK actually then view you as an investor as lower risk because now you have proven that you know how to manage the Golden Goose property well. You are paying your mortgage on time, and they would be more open to lend you more at even more favorable interest rates, up to 75% and at lower interest rates. So that actually is a huge aha moment with regards to lending and investing in the UK. The properties there can cash flow. They often stress test the deals on a multiplier of rent. Essentially, there are lending options, and the more you grow your portfolio, the more the lenders want to lend to you. It's a bit funny in terms of lending, right? At the start, when you really need it, they're more reluctant. But once you're very established and technically you don't really need that much lending, they're like, oh, please take my money, because they know that you are able to manage monies well.